Let's do some examples of sales transactions for a merchandising firm. Anytime you have a sale, because we're dealing with merchandise, there's two sides to this. There's a sales price, but you also have to consider the actual merchandise that's leaving. Hopefully you're not selling your merchandise for the same amount that you purchased it or that it cost you. So there's always two numbers involved. So there will always, with every sale, be two journal entries. Okay, one will deal with the sales price, one will deal with the cost of the inventory. Okay, so if we had a sale and the sales price was, say, $300, okay, and this was a sale on account, we would have accounts receivable. Someone owes me $300 now, so we're going to debit accounts receivable for $300. We're going to credit sales, our revenue account, for $300. That's one piece of it. That shows the sales price. Okay, we earned $300 and we should get that at some point in time. Okay, otherwise if this was a cash sale, we wouldn't have accounts receivable there, we'd have cash. But I'm not done because that shows the sales price and that's good, but I really did give you merchandise. You purchased something from me. So I also need to show that the merchandise left and the cost of that to my company. So we have, I'm going to shortcut this, cost of goods sold. COGS, cost of goods sold. Alright? So let's say that that merchandise cost me, I don't know, $100. So I'm going to debit cost of goods sold, increase it by $100. This is like an expense account. And then I'm going to credit the inventory account because that inventory is gone. It literally left my building. You took it with you, or the customer did. Alright, so we need to decrease that account. We don't have that inventory anymore. We sold it. I can also tell you from these two transactions what the gross profit of this sale was. Again, gross profit is a total, a figure that we use, and we're going to see it in our multi-step income statement, but it's not an account. But it's just the difference between sales and cost of goods sold. So for this individual sales transaction, my gross profit was $200. Right? Other items we can look at with sales, one would deal with freight. Let's talk about that. Again, it depends on your freight terms. If the seller is responsible for freight, right, then what happens is when they pay it, my entry would be something like, let's say that we paid a freight charge of $50, right, and we were responsible for it. It was FOB destination. So the seller was responsible for the shipping charges. That is an expense for me. So I could use two accounts. I'm going to put either one of them up here. You could use delivery expense, or you could use freight out. Both are expense accounts. So whichever one you choose to use, we're going to debit it for $50. Either one. And then we'll credit cash or accounts payable if we paid cash or if it's on account. There we go. So there's some freight charge. Now if this was FOB shipping point, the seller's not responsible for it. The buyer is. But if for some reason the buyer paid the shipping and they were not responsible, it was just a courtesy, well now that buyer owes us some more money. So we need to increase their accounts receivable for that. So let's say it was $75. So we would increase their account receivable. Okay, it's an asset, it's going up. And then we'd credit either cash if we paid cash, or if we now owe someone else money, we would increase the accounts payable account. Alright, we had returns and allowances on purchases. We can also have returns and allowances on sales because a customer can bring something back to us. They have a return. Okay, if that happens, we actually have a special account for that. Now, if they bring us something back, again, this is a sales figure, deals with a sales transaction, so we're going to have two things that we have to account for. One deals with the sales price, and one deals with the cost of the inventory. Because if they bring something back, they really physically will bring something back as a return. It can be easy to get these confused, but just remember what dollar goes with which item. Okay, so if they're bringing something back, let's say it was a sale on account, well, they don't owe me that anymore because they've brought it back. So we know accounts receivable should be involved here. Okay, we're going to be decreasing that account. Let's say I had a return and the sale was for, I don't know, $30. We had a $30 sale that is being returned. We're going to use a special account for that return called Sales Returns and Allowances, if I have enough room for it on here. We don't want to take this against the sales account because we want to keep those gross sales all there. So if we have a return, we want to account for it in this special revenue account called Sales Returns and Allowances. This is actually a revenue, but it is a contra revenue. Anytime you see contra, think contrary to the norm, contrary to whatever it is. So it's a contrary revenue. It's a contra revenue. It acts in the opposite manner. Revenues are increased with credits, and they hold a normal balance of a credit. So this account is a contra revenue. So sales returns and allowances would be increased by a debit and hold a normal balance of a debit. So we said it was $30, so we would increase this account for $30, and we would credit or decrease the receivable for $30 because they don't owe me that money. They've brought it back, and that was the sales price at which they bought it. But they also really did bring me back inventory. So I'm going to increase my inventory because I have a piece back. And let's say that that was at a cost of $5 to me. Don't record the 30 here. Again, hopefully you're not selling inventory for the same amount that it cost you. Otherwise, you wouldn't be making a profit. So we need to know the cost of that inventory. If our cost was $5, we increase our inventory back that $5. And then we're going to decrease that cost of goods sold because it's no longer sold. So it doesn't need to be in that category. So this is almost like a reversal of the sales entry. But again, we don't take this directly against sales. We take it against this new contra revenue account, sales returns and allowances. One other transaction we can look at is the same thing we looked at with purchases, but on the sales side with a discount. Okay, we could extend our customers the option of having a discount when they pay us. And again, this can be just like we looked at with credit terms. Let's get a new page. Or, I mean, you could even think about it like a coupon kind of a situation. But whatever the discount is, the customer's going to pay us less than they owe us. And let's assume this is for sales on account. So let's say we have an accounts receivable and they owe us, I don't know, $500. Okay? And we give them a very generous 10% discount. So, how much cash are we actually going to get from them? Well, again, we had so $500, we're giving them a 10% discount. Or again, if it was credit terms, the credit terms would tell us, if it was 210 net 30 or, 110 net end of month, whatever that is, then we could get that percentage and apply it. Just trying to make it some easy math. So we're not going to get $500 in cash because we've got this discount applied. We're going to get $450. So we're going to debit cash of $450. Because $50 of this is a discount. So again, we're not going to take this against sales because we want to keep that at the gross amount. We're going to use an account called Sales Discounts. Oh, I'm sorry, I'm trying to squish it all in so I can get the 50 in the right spot. Okay, for $50 because this is also a contra revenue, right? Just like sales returns and allowances was. And then we take off the full amount of their receivable because we show on the books that they owe me $500. If you only took $450 off of this, it'd still look like they owed me $50, but they don't because that $50 is the amount of the discount we've extended to them. So all of the $500 needs to come out of their accounts receivable, but they're only paying me $450. So that other $50 goes into that contra revenue account of sales discounts.